Investors got a fresh look at the economy this week with inflation at a 3-year high, first quarter GDP revised upward, and oil prices falling sharply. Investors are wondering if those data points mean the Federal Reserve is headed for a rate hike. Joining me now, Invesco global market strategist Brian Levitt. Brian, great to see you again.
Great to be here.
Congratulations, your Knicks.
Oh yeah, that was something.
For half a century. Okay, so Kevin Warsh's first Fed meeting, and the markets got spooked a little bit. It was more hawkish than they expected. Now the market's actually pricing in a rate hike. You think the markets might be wrong, which is not something you often say.
Yeah, the irony of it is, if you think about what was going on in March of 2026, we had oil prices racing up, and we had 3- and 5-year inflation break-evens rising. That's when you're in more of a concerning environment. I know there's still some stickiness with regards to prices, but the reality is oil prices have come down substantially, and inflation expectations have come down substantially. And Fed's already somewhat restrictive, relatively flat yield curve. I don't think they're going to raise interest rates into that.
So talking about inflation, you started, I guess, with the COVID supply crunch, but then you had a Trump stimulus. Biden piled on with his own stimulus. You had the Ukraine, the Russian attack on Ukraine, hiking oil prices. You had tariffs. You had the Strait of Hormuz. Some people are starting to say, we can think of many reasons, but maybe it's not only transitory, that this is the new normal. What do you think about that?
Well, a lot of those were supply-driven inflation, right? And supply-driven inflation should be viewed differently than demand-driven inflation. You know, demand-driven inflation that causes prices to rise, wages to rise, prices to rise again, that's what you need to be more concerned about. These supply shocks should be viewed as such. They're supply shocks that are basically a tax on us. And in the case of tariffs, they actually are a tax on us. So you need to respond differently to a supply shock. Oil prices certainly going up during Russia-Ukraine, or in this instance, a supply shock. And in both cases, they abated. You would not have wanted to raise interest rates into those environments.
Because essentially it just piles on. You know, you got to pay more for gas and
yeah, it's a tax on us.
Okay, one more inflation question for you, and that is AI. Supposed to be deflationary. But in fact, as we talked about in the earlier segment, it's causing the prices of chips to go up. It's causing, data centers, so construction costs increase. We're not seeing the deflation we're expected from AI.
Well, not in the current moment. I mean, ultimately, AI, you will get goods cheaper, more abundant, quicker. So over time, artificial intelligence should be deflationary. What you're dealing with right now is, at the beginning of the year, people wondering if there was a lot of demand for artificial intelligence. I think we all agree the answer to that is yes. Now it's, can we supply it? And so you'll get some log jams on this. Ultimately, if the prices are good enough, manufacturers will produce more, get into that space. So ultimately, those prices will come down. I think what investors should think about, though, is you're going to see prices of electronic goods move up as a result of it.
Which is weird, by the way, because over the long arc of decades, they always got cheaper.
They always got cheaper. And, the economists estimate it may add 0.2 to 0.4 to the consumer price index. But you have counteracts to that. You've got housing prices that have been moderating. You certainly have commodity prices that have been moderating. Food prices should come off the boil. So those things will offset some of what you're seeing. And I would, investors that are focusing too much on the news of inflation, the headline numbers, watch what the market's telling us. Those break-evens, the bond market's expectation for inflation have come down quite a bit.
Yeah, 10 years been falling. Okay.
Yeah.
Finally, Brian, you convinced me that you're right, that rates are coming down. What should I be doing in my investment portfolio?
So if you believe that we're going to be in more of an easing cycle, which we have believed, the yield curve is very flat. If we start to normalize it, you already see what's outperforming. Small caps, you're seeing REITs perform well, financials, industrials. People talk about a tech wreck or some recent sell-off in chips. It's a rotation. This is the type of rotation investors had seriously wanted in 2024. And so what's driving that is better economic growth, lower interest rates, oil prices down. All of that should help broaden out the markets, and quite frankly, they already have.
Just 30 seconds left. One more asset class. Emerging markets had a rough go for a while. You think that, and recently they've been doing okay. You think their time is nigh?
Well, they've been doing well largely because of Korea and Taiwan, right? It's been very concentrated in a handful of companies. The emerging markets tend to perform well with global growth and with the Fed easing and a weaker dollar. And so, yeah, we believe all of those still line up. That was our view coming into 2025, our view coming into 2026. years. Disrupted briefly in each of those years by some type of policy decision, Liberation Day, and the war in Iran. But yeah, ultimately, we think that continues to play out.
You're looking past it.
I'm looking past it. Thank you.
Brian Levitt, thanks so much.
My pleasure.